Hi guys, and welcome to Trading Places financial education videos. This is episode 2 and we're going to be focusing on risk management and how to calculate the correct lot size to be trading on each trade depending on the size of your stop loss. This is one of the most important areas of trading to make sure you don't overtrade and experience too much drawdown on your account. What we have found is a lot of new or novice traders don't really understand what a lot size is. They don't really know how much their potential loss could be on their account, and therefore when they enter a trade they've got no idea the potential loss they could incur. What we're trying to show in this video is how to determine to cap your loss at a set amount percentagely on your account. In doing so, I've developed a spreadsheet, an Excel spreadsheet, which will easily be able to tell you the exact lot size to be placing the trade with in order to cap your potential downside. What we've noticed is a lot of new traders, or even some intermediate traders, they still believe that whatever currency pair you're trading, whatever currency your account balance is held in, each pip of movement equates to $10. So if a price moves 5 pips and you're trading one standard lot, that would equate to a $50 rise or fall on your account. Now this is totally wrong. If you're trading New Zealand dollar versus Japanese yen, for instance, how could one pip price movement equate to $10, especially if your account is held in Great British pounds? So I think this is a really severe area which needs to be addressed to try and inform traders, aspiring traders, how to properly risk manage their account and how to quickly work out exactly the lot size on each trade. Okay, before we go any further, I'm sure a few of you are thinking, what is a lot? What is a lot size? Basically, in the past, Spot FX was only trading in certain amounts called lots, or basically the number of currency units you would buy or sell. So there are 4 main lot sizes what I used: a standard lot, a mini lot, a micro lot, and a nano lot. So a standard lot is 100,000 units of currency. A mini lot is 10,000, a micro lot is 1,000, and a nano is 100 units of the chosen currency. To be honest, the mini, micro, and nano are pretty rare, only really used by really novice traders. So the normal size which most traders would use would be a standard lot. Now, in order to work out how many standard lots you need to be trading, I've developed an Excel spreadsheet, as I mentioned here. Now we can see it's pretty straightforward. It's got the fields clearly marked here. Account currency, this is the equity you hold in your brokerage's account. Account balance, risk per trade, it works out the cash risk per trade, pips to stop loss, and risk per pip. Now before we move any further, what we need to do is we need to make sure the standard lot price is correct. So we'd click data, refresh all, and we can see down here it's running a background and now it's refreshed. So the correct price is completely up to date. First off, account currency. So what's our equity held in? Is it pounds, dollars, euros, yens, whatever it is? So we're going to stick with Great British pounds for the time being. I've entered an account balance of 10,000. This is just a generic amount, which is probably quite a common amount for the novice or intermediate sized trader. Underneath here there's a risk per trade. Now this is a percentage risk of drawdown you are willing to experience on your account if the stop loss is hit. Now I've got it set to 2.5%, which is what I use. Some people would like to experience slightly more risk, 5% even. I wouldn't recommend going over 5%. If you did, for instance, 10%, you can see the cell turns red, indicating danger, over trading, and you could potentially be margin called. So if we change that back to 2.5%, you can see everything automatically updates. So it's worked out our cash risk per trade and our pound account of 10,000 will be £250 by risking 2.5%. So that means if our trade does hit stop loss, the most we can lose is £250. So now, if we say pips to stop loss, if we go back to our chart here. This is euro dollar, and we use our long position tool. We can just enter any long position. It doesn't matter. This is a completely fictitious trade. We can have a long position set up there. We can identify we want to have a stop loss here. We'll make it rounded up to make it easier. So we've got a 40 pip stop loss. So you can see here we've got this trade we've identified has a 40 pip stop loss, a 319 pip TP, and we have a risk to reward ratio of 7.98. So all the information's there. So if we go back to our Excel sheet, we can put pips to stop loss 40. It works out each pip we want to be risking £6.25. Now we go back and just double check the trade. We're trading euro dollar. So that means the right hand side of a currency is US dollar. If we were trading Aussie dollar yen, you would go and find yen because it's right hand pair. If we were trading pound Canadian, you would select Canadian. So it's always a right hand pair. So as it's euro dollar, we go back and we find US dollar, select that. So we know the standard lot price is correct. We've just checked it out. So it works out we need to be trading 0.82 lots. If our trade hits stop loss, the most we can lose is £250. So when we're going to our MT4, we're going to place our order, our buy limit or market execution, whatever it may be, in order to buy this currency. We need to know we need to be placing 0.82 lots. So we need to be placing a buy limit order at 1.11302 for 0.82 lots with a stop loss at 1.10902, and the most we could potentially lose on this trade is £250. Now this is a very simple way how to manage your account properly, how to risk manage efficiently, quickly, and how you can control. You're not going to get margin calls, you're not going to blow your account on one trade. And it's the safest way to trade FX, knowing how much you can lose. The only thing you can control in this market is how much you're willing to lose per trade. You know, you can't control if it goes up or down or left or right, but you can put a stop loss in to say if it does go below this, I want to cut the trade, and you can work out the lot sizes to your stop loss to make sure you only incur a certain percentage loss on your account. And it's the one thing is to protect your capital. Without this, you will lose your money. I mean, the stats are quite horrendous for retail traders. I think 90% of traders lose 90% of their money in the first 90 days, and it's due to they don't understand lot sizes, they don't understand risk management, and they don't understand how to calculate the lot size to a stop loss. I think that kind of brings this video to an end. It's quite clear and quite simple. If there are any questions regarding risk management or where you can get the risk calculator from, or any other queries that one may have, please reach out and contact me on WhatsApp or Instagram Messenger. It's trading_places_FX on Instagram, and I'll obviously get back to you then. That's great. I hope you've enjoyed this risk management video and it's been educational for you and beneficial. Thank you.